What's going on YouTube? It's Gan and Mo. So let's address the big elephant in the room. Why am I so red? Well, no, it's not because I went on the beach and forgot all my coconut oils. It's because I actually ran my first half marathon today. So yay, go me. And you could show some support by gingerly tapping that like button as well. But let's dive into the topic of this video. What is best for your rental property investment? A 15-year or a 30-year mortgage? And let's dive right into that.
Now, buying rental properties is a great investment, especially when you're able to get a mortgage and get some great cash flow on that property. Now, some investors choose to get the 15-year mortgage because they want to pay off that property faster and it comes with a slightly lower rate. Now, at first glance, the 15-year mortgage might appear to save you more money in interest over the lifetime of the loan because it comes with a smaller interest rate. But I personally prefer to purchase properties with a 30-year fixed mortgage because it allows me to have more cash flow month to month, which allows me to purchase more properties instead of paying off that property faster.
Now, one of the biggest advantages of a 15-year mortgage is that it's a lower interest rate, about 0.5 to 0.65 lower than that of a 30-year mortgage. And that allows you to pay more on the principal and less on the interest.
Now, don't make the mistake of assuming that the 15-year mortgage is actually a shorter mortgage because you're always able to take on a 30-year mortgage and pay it off in 5, 10, 15 years without committing yourself to a shorter and a higher monthly payment. As well, you can always apply more principal payments to the mortgage itself to cut down on the duration of that mortgage. Now, you are paying a higher interest rate for a 30-year mortgage, but think about it this way. You are paying for the flexibility as well as the ease of mind without the commitment of a higher payment.
Now, a major misconception is that many people assume is that the interest is front-loaded on a mortgage, on any type of mortgage, aka they're making more payments towards that interest than their principal itself within the first few years.
Now, all of us know a friend or have a friend who always says, hey, I just took out a mortgage and all my payments are going straight to the interest and I'm not making a dent on that principal balance.
Sorry, folks. That's not exactly the full story. Math isn't on your side for this one. You actually do pay more interest at the beginning of the loan because the principal balance of that loan is higher. But as the years go on, that principal balance comes down. So you're actually paying the same interest rate on a smaller balance.
Now, to be fair, you do pay less interest with a 15-year loan. Now, on every $100,000 that you borrow with a 15-year loan at a 4% interest rate, you typically can expect your monthly payment to be approximately $740.
He's doing
now,
numbers. I love
over
it.
the lifetime of that loan, which is 15 years, you're going to be paying a total interest of approximately $33,000. Now, let's take a 30-year mortgage and take that same $100,000. But like we said earlier, you are going to be paying a slightly higher percentage interest rate. So let's take 4.5% for this example. Now your monthly payment is going to come out to $507. Now over the 30-year time period, you're going to be paying a total of $82,000 in interest.
Math does not lie.
Now that 15-year loan is actually going to be saving you on paper $50,000.
But that's not the full story. As Mo mentioned, your monthly payments on a 30-year mortgage is $507. And on a 15-year mortgage, they're $740. That's $233 difference. My math is quick. Now, if you take that same $233 and apply it to your 30-year mortgage, remember, you could pay off that mortgage in 5, 10, 15 years. Be a superstar. It would actually take you 17 years to pay off a 30-year mortgage. And the total interest you're actually paying is $39,754. I'm like Rain Man. Now, in this example, yes, you are paying $6,000 roughly more for the 30-year mortgage in comparison to the 15-year mortgage. But in all reality, that $6,000 goes a long way when you're speaking about peace of mind and flexibility. And that $6,000 is going to be worth much less in the future because of inflation.
Funny enough, we actually have a video on that in our library. Check it out. Now, we're not trying to argue facts here.
We're just discussing.
Now, yes, the 15-year mortgage will save you a lot of money in the interest. But another consideration I want you to keep in mind is that in reality, you are paying less in the monthly payment month after month for the duration of that loan. So year after year, having that 30-year mortgage versus the 15-year mortgage will equate to approximately $3,000 a year in savings.
Now that $3,000 a year that you saved by picking the 30-year mortgage, as Mo mentioned, you could do so many things with over the long run. You could buy more rental property, build an emergency fund. You could take Gan and Mo out to dinner. You could actually pay off that 30-year mortgage quicker because remember, we said the 30-year mortgage could be paid off in 5, 10, or even 15 years. And remember, inflation actually destroys money in the long term. It actually decreases its buying power.
Actually, it takes approximately 24 years before the 15-year mortgage makes any sense whenever inflation is considered. And by the way, I like steak. Now you might be watching this video and asking yourself if we switched careers, if we became mortgage brokers. No, we're
Side
still
hustle.
doctors. We're still practicing what we do best. But we are biased towards the 30-year mortgage because it will help you qualify for more properties down the line. Now, most people, whenever they're starting to invest in real estate, they don't look into the future. They don't know what banks ask for whenever they're applying for more properties. Well, banks always look at your debt-to-income ratio, and as healthcare professionals, we tend to carry a lot of debt due to our student loans. So it's very important to get that 30-year mortgage because your payments are going to be a lot lower, which will help you with your cash flow month after month, and that will help you qualify for more properties.
Now remember, there is no true advantage of having a shorter duration loan unless you decide to pay off that loan in full, refinance, or sell. And the mortgage payments on your home will actually be the same until that loan is paid off in full. If you need to access the equity in your home, you cannot just go to the lender and ask for that money you put in earlier. And if you have a 15-year mortgage and something happens, a medical emergency, you lose your job, you can't pay those payments, the bank will not lower those monthly payments for you.
Now, on the other hand, if you do have a 30-year mortgage and you're applying additional payments month after month because you want to pay off that mortgage faster.
Baller.
Well, in all reality, if an emergency does happen or if you do lose your job, all you have to do is just stop applying with additional payments and you should come out of it just fine. Now, I can only speak for myself and not this guy over here.
I don't want you to speak for me.
And my own personal goals. And my personal goals do include owning as many rental properties as possible. So the 30-year mortgage will allow me to have more cash flow month after month so I'm able to qualify for more properties and purchase the amount of properties I need for my goals.
And if you take that money that you're saving in a 30-year mortgage and reinvest it, the results are exponential. So let us know in the comments below, are you a 15 or a 30-year type of mortgage person? And don't forget to gingerly tap that like button and subscribe to our channel, and we'll see you next time.